The CSO have released the quarterly national accounts for the second quarter of 2011, and the numbers are sure to get a lot of attention over the coming days. Uh, we're looking at the headline, the figures seem quite positive from an Irish perspective. So here we have real GDP, quarterly real GDP going back to 2005. And then we can see for the past two quarters, real GDP has been increasing. This is the first time we've had two quarters of consecutive growth since back in 2006. Um, so quite a turnaround in recent times in our GDP figures. So we can see the drops that occurred, dramatic drops that occurred through 2008, 2009, a bit of a flatlining then during 2010. And the first two quarters of 2011 have suggested that the Irish economy, um, if not going beyond stabilisation, at least has stopped to decline. If we look at the quarterly growth rates, again we can see the two positive quarters of growth here at the start of 2011. And we can see when the Irish economy entered into recession in 2008, when we had two quarters of negative growth here in the middle of 2008, and these negative growth figures continued right through 2009, when the recession officially ended at the start of 2010. And since then, we've had some negative quarters, but we haven't had two negative quarters in a row. So it will take two negative GDP quarterly growth rates for the Irish economy to tip back into recession. And as it is, we've actually had two positive quarters where the growth rate has been greater than zero. If you look at the annual changes again, we see a similar pattern emerging. Most of the large downturns occurred in 2008, 2009. In 2010, we got back towards zero, but there was little sign of an actual increase in activity in the economy. Before now, as we see in 2011, the annual growth rate has tipped back into positive territory. The big issue now is whether this will be maintained over the medium term. As you can see, the GDP growth rates can be quite volatile and move around. So we still haven't sufficient data to suggest that there's a change in the long run trend. By the time it comes to quarter three and quarter four, and there could be changes here. But for the first two quarters of the year, the figures remain reasonably positive. Just looking at different components of the economy, first we'll focus on the domestic economy, so consumption in the economy of goods and services, investment in and fixed capital formation, and expenditure by government on goods and services. So these are the actual levels, as we can see. And if we look here, we just look at them in index form, so we'll just put them equal to 100 at the start of 2006, and see them rising up to 2006, 2007, and then falling. The most dramatic and largest fall has been in investment. So investment is about more than 50% off its peak value, nearly 60% off its peak value. But in real terms, so these are in constant prices, has been beginning to edge up over the last 2 or 3 quarters. So it does seem to have investment found its bottom, and while the growth isn't overly dramatic, it does seem as though the decline has stalled. When looking at consumption and government expenditure, we see that these peaked through 2007, 2008, and then began to decline from there on in, and both are back below now 2006 levels. Although if we look at consumption, the blue line, we can see that most of the fall here occurred during 2008. In real terms, consumption has been relatively stable for the past 2 years or so. In fact, in the first quarter, second quarter 2011, rose up ever so slightly. We can see the impact of the changing government policy with the budgets being introduced since 2008, with the fall in government expenditure on goods and services. And this has fed through into the overall domestic demand. And if you look at the domestic economy, the pattern since the peak in 2007 has been dramatic. Huge drops in the domestic economy. The domestic economy has suffered hugely over the past 2-3 years. So the drops were very, very fast and dramatic in 2008, 2009, slowed somewhat during 2010, and early indications are in 2011 that the domestic economy is bottoming out. Again, we'll highlight that one or two data points aren't enough to make this judgment. And as we see in 2010, there was a period when the domestic economy grew, and that was quickly followed by a decline. So this turn here in 2011, it'll take another couple of quarters of data before we see whether this is continued over the medium term. But the drop in the domestic economy has been quite dramatic, and has led to the contraction of the overall economy. The reason the direct contraction of the overall economy hasn't been worse has been because of our trade figures. Our balance of exports has been growing over the past couple of years. So the balance of exports, so if the domestic economy had been contracting hugely since 2007, our net exports have been rising unrelentingly since 2007, rising from about 4 billion a quarter, and now they're heading for a record 10 billion a quarter. So a huge rise over quite a short period. So this has cancelled out a lot of the contraction in the economy that was seen on the domestic side. The trading side has compensated with a huge increase in net exports. Initially, this increase wasn't necessarily coming about because of positive reasons. So if you look at 2007, you can see that our exports were actually declining. So 2008, 2009, we had falling exports. The reason why the balance of trade was rising was that imports were falling more rapidly. So the gap was getting larger, not because we were selling more, but because we were buying less. So imports were falling. It's only in the past 18 months or so that exports have reversed and begun to rise, and even imports have begun to reverse and rise. So recently the gap has been getting wider because exports are growing faster than imports. And this is essentially a good thing. So while much of the recent increase in the balance of exports, balance of trade has been because of falling imports, we're now at the situation where it's rising exports. And even the rising imports in Ireland aren't necessarily a bad thing. On the goods side, 60% of our imports are for goods for production. Only over 30% of our imports are goods for consumption. So rising imports generally means rising activity. So during 2009-10 our imports were rising, but we see now that this has flatlined and eased off. On the services side, most of our imports are patents for pharmaceutical products and copyright for software and computer services. So rising imports in Ireland generally lead to rising exports, and you can see the correlation between exports and imports. When imports fall, exports fall. When imports begin to rise, exports begin to rise. So the balance of trade has offset much of the fall in the domestic economy. So on the goods side, we see that our exports have been just relatively steady over the past 4 or 5 years, and with perhaps an upturn seen in the last 12 to 18 months. Our goods imports fell dramatically in 2008 and 2009 and have been rising slowly since then. So again, 60% of our goods imports are goods for production. So this upturn here is necessarily a good sign, which should feed through into rising exports over here. On the services side, our services imports and exports track each other quite closely, and in fact our service imports are larger. So most of these are patents, royalties, copyrights, etc. So patents for the pharmaceutical sector and copyrights for the software sector. So if you look at our overall balance of trade, we run a huge balance of trade in goods, again hugely determined by the chemical and pharmaceutical sector. So the cost of the raw materials they bring in is quite low, and the value of the products they sell is very, very high. So a huge balance of trade surplus on the goods side. On the services side, we run a balance of trade deficit. So a balance of services deficit, again partially driven by the pharmaceutical sector, where the import of patents is picked up on the services side, and the export of the goods based on those patents is picked up here. We also have exports of computer services, which drags the balance of services deficit up to a lower level. So Google, Facebook, etc., all selling their services through Ireland, they themselves would run a surplus. So we have a balance of goods surplus and a balance of services deficit. Just looking briefly at our GNP figures, so here's the GDP figure we looked at earlier. Our GNP figure is showing a bit of upward and downward motion over the past year or so. Fell by about 3% in the first quarter, and then there was a small rise in the second quarter. Again, it just seems to be flatlining, neither going up nor down, so we don't see the falls that we're seeing during 2008, 2009, and still not enough to suggest that a continued upward expansion of GNP is likely. The most recent data points are positive, but will take more to make a firmer conclusion. When looking at our GNP, one of the big factors is the flow of profits into and out of Ireland, more specifically the flow of money out of Ireland. So net factor income from abroad, so the balance of monies entering and leaving the country, the balance of profits entering and leaving the country. And you can see this is quite a volatile series. And for the second quarter of 2011, it's in fact as low as it has been since 2005. So nearly 9 billion left the economy in factor income in second quarter 2011. That's a net. About 13 billion came in and about 22 billion left. So the balance was that more money left the economy to form repatriated profits than entered the economy. And you can see that this figure is as low as it has been quite recently. So the fact that GNP rose even with this large outflow is a positive sign of the economy, that the amount of money staying in the economy, the amount of money earned in the economy is beginning to grow, largely determined by the GDP growth above here. So again, the issue is whether this can be sustained. So the fact that GNP is rising with such large outflows is a reasonable positive. Just looking at the growth rates, again it highlights why we shouldn't put too much weight on one quarter's data. You can see the volatility in the growth rates, but again you can see that the positive growth rates for both GNP, the red line, and GDP, the blue line, in the second quarter of 2011. It's clear we've moved away from the sustained contraction that occurred during 2008, 2009, and now we're in sort of a period where growth rates are varying from positive to negative. The issue is whether we can hold on to the positive growth rates over the medium term. Again, an annual comparison, when looking at the growth rates, shows something similar, fairly substantial and very large negative growth rates, particularly during 2009. We got back towards zero in 2010, and now we're edging into positive territory. Again, the GNP a bit more volatile based on the flows of income, the net factor income from abroad. And finally, just looking at some of the contributions to economic growth, if we just break down the domestic economy and exports. So we've looked at the domestic economy contracting quite dramatically in 2008, 2009, and contributing negatively to our growth rate. And look at exports growing through 2008, 2009. So exports contributing positively to the growth rate. And we can see that the impact of the domestic economy has generally been getting smaller as we progress through time, and in fact contributed very little to the growth in the second quarter 2011. So domestic demand largely flatlined in the second quarter, and there was some gain or benefit from exports. If we break it down even further and look at the impact of domestic demand, so again the orange is the net exports, which are largely positive. Those below the line are contributing negatively to growth, and we can see that the dominant one is investment. This is this part of the domestic economy that has contracted the most and has contributed the most to the negative growth rate. And if you were to further break down investment, you would see that most of it is to do to construction, and of construction most of it is to do with house building. We've gone from building nearly 90,000 houses a year, as it was in 2007, to around 10,000 houses a year for this year. So a huge contraction in the construction sector, and particularly the home building sector. In a sense, this is a necessary contraction. Building 90,000 houses a year was not sustainable. So these drops, these negative contributions to growth, are largely to be expected. If you look at the other sectors, we can see in 2008 consumption was dragging down economic growth, but more recently the effect of consumption has been quite small, and the effect of the government expenditure on goods and services on the growth rate hasn't been dramatic, but we can see since 2009 has led to the further contraction of the domestic economy. And I suppose other government expenditures such as transfer payments would be picked up in changes in consumption. The government isn't spending the money on goods and services, will be giving it to people in the form of incomes, and they may be spending less. But overall the economy is moving towards a situation where the domestic economy seems to be having a small or negative effect. We still won't say the domestic economy is growing, it's still in a very moribund state, and our net exports continue to provide the key driver of growth within the economy. So that's just a quick look through our national account figures. I hope you picked up something from it.